Hello, what's up everyone? This is Imi. What you see on the chart is my trading platform MT4 and the very simple template that I have. So the dash line is the 10 EMA, the solid line is the 20 EMA. On the left you see the DAX 30 M5 chart, and on the right you see the M1 chart. What you see on the M5 is a particular pattern that I wanted to talk about. The setup one is basically the concept of the Elliott wave, where you have a wave 3 up and a sideways flat wave 4 followed by a wave 5 up. In the price pattern, and I might add here, is that with every, and this is what I've learned, it took a while to understand. I mean, I should have learned it ages ago, or maybe I knew it, I just ignored it. The indicators that we use, or any type of indicators, for example, we go to this setup here. So this is the Hunt 2.0 indicators plotted with the normal setup one template, right? And so you see all these indicators doing their calculations. So what the indicators would do is that most of the indicators will calculate based on the past certain number of candles. So for example, the green line is the smooth moving average of the past 5 candles, whereas the purple is the past 34 candles. Same is for the AO. The AO is basically a histogram plotted between the difference of 5 simple moving average and a 34 simple moving average, which would be something like the distance between the green line and the red line. So as the 5 moving average, which is the last 5 candles, as they move away from the averages, the histogram would go bigger because the distance between the two lines is increasing. So these patterns indicated or created by the indicators would often be what they call, they would lag, but in their own world they don't lag, because the pattern that they create with whatever lag is valid and it works in its own way. Why do they call it lagging? Well, it lags behind price, and although to most traders, when they hear this, they feel like their interpretation of lagging is automatically, they assume it's a negative thing. Lagging doesn't mean it's a negative thing. They lag behind price because it is based on the past prices that it creates that pattern. But for example, this pattern here, you were to go long above the box with the stop loss here, you have a nice lovely trade. You have this pattern here, pullback. Now the interesting thing is that whatever pattern that you have found that seems to work, for example, the setup one pattern that we know that it works, it gives you 70% win rate if you trade it correctly. That pattern can be squeezed and you can find its equivalent price action pattern, which is a fascinating thing. And there goes the lag issue in there. So price itself lags behind something else, which is the whatever happens in the world, you know, economic events, traders mindset, algorithms, all of that happens. Price lags that. We can't access what goes through the minds of millions of traders, or the bots, or whatever economic events that would create the shifts in trading activities. But what we see on price is the earliest information of those changes that we have. So what you see here is prices going up and coming down. This is a sequence of buying pressure that's going on, and it's not just for one, it's 30 German stocks on the German stock exchange. So around this time, the index was growing every minute. That means that the calculation of the 30 stocks based on whatever method they use to calculate was simultaneously going up. So we're trading the whole market, in a way, all 30 big companies, trillions of dollars in there. And then that's the reaction of it coming down. There would be traders or algorithms or methods and all of that going individually into those trades, you know, into those stocks, and those stocks will be moving, and this index will be calculated based on the cumulative or the collective movement of those. But even then, it follows the same type of patterns. It follows the big round numbers, and it does all of those. It bounces against supports and resistance. Sometimes it even baffles me, but what matters is that we have patterns that work. One of these patterns is setup 1. And if you squeeze that pattern into, for example, you have a setup 1 happening on an M1 chart. Let me find a good one. For example, this was a setup 1. Now, it's not a really bad one, but it's not really awesome one either. And the reason is that, well, it's kind of okay, but I think the wave 4 was a little bit too wide in its, you know, in its gyration. It took a little bit too long as well, and the box wasn't really tight. So if this formed a level over here, for example, right, and then it was tight, and then it started, the box broke from there and came all the way there, then you would have had quite a lot of pips in there. But even then, it was a winning setup. This setup, I have found, is that good setup 1s basically are formed of between 40 to 90 candles. And then if you do a bit of math between the 40 and 90 candle, and you keep switching time frames, for example, that's 5 times over. So when I went 5 times, that same pattern, let's go back there. So if this pattern of wave 3 down and 4 up, and that's 5 down, although it says 3, it's because price has gone all the way there. Around this time when it was happening, this would have been printed as 3, this would be 4, this would be the 5 after this. But we don't really see 5, and we don't need to see 5, we need to see 3 and 4, because that's the setup, and we know that after that 5 will happen. Now, whatever type of 5 will happen, it's a different thing. So if I look at this chart here, between this point and this point, how many candles do I have? That's about 70. So it's a good setup 1. So if you can see the M5 chart here, but if I switch that there, you can see that on the M5 chart, that same pattern squeezed has turned into 13 candles. Let's count it. See this? So based on this, we have developed the hunt methodology. It's like, okay, because we want this type of pattern, so here's how it goes. So when I look for a setup 1 like so, I want the M5 to have a pattern like so. I want it to be breaking out of a box and then pulling back to the gator. I want the gators to be open. And at the same time, I want a setup 1 here. And then you can say, okay, what if I were to trade the M5 chart just using this pattern? That gave birth to the hunt methodology. That's what it is. And then I realized is that the setup 1 pullbacks, well, I must first say is that basically the hunt method is a pullback pattern. Now, when you get exposed to or you get experience with a lot of these pullbacks, hundreds of them, you'd find out a particular pattern within the pullbacks, though that actually work the best. So the reason I'm showing you this chart is that although this is not the best example because the market has gone down and then gone up, but if we just focus on this part of the chart. So what you see, let me expand it. What you see is market went down, went up, and then came back and it was rejected at these box levels. See, this is what we need to learn. I know in AIMS trading we're looking at boxes and we're looking at indicators and stuff, but we have to learn these price reactions to these levels. So if you look at this, price comes here, goes up, comes down, and as it reacts to these levels, and there must be a level somewhere. I'm going to put a line there, and later I will go onto a higher time frame. You know, when price comes back up, and here it's reacting to these levels, and it's not just this level, it's all of this. See? So when this happens, you know that price is reacting to the box lows, and it's reacting to these previous highs, and it appears to be like reacting to the green line. This over here gives me this confidence that, okay, although price has been rejected here, but there is enough selling pressure around those levels that it's not letting it go up. So I go short here. I go short here heavy. So often I would find myself short here randomly just below this box level. And where would be my exit? I know that if price went above this, I'm not interested. So I'll have my stop loss somewhere there safe. So that's about 15 stop loss. As the market starts to come down, I'll probably add on. But as it goes up, I'm scared here. But when I see a confirmation again, like a strong candle like this, then I would go short here again, right at the close of it. At the close of this candle, I'll go short again. But this is the area that I'm targeting. I will either close my shorts that I took from there around this level, or I would close half of it or 70% of it. And then when I see a candle like this happening, I will either take out the rest of the position, or I would let it play out. In most cases, if there's a strong rejection like this, I know that it's not going down further. I'm out completely. And I would say, okay, the decision I took here was right. But sometimes I get out and then it drops. But that's not a problem, because when it drops further, then I would be looking for another pullback. Now, in this occasion, now what we see, if we were trading reversals as well, price goes sideways, like, you know, this bit happened and price went up, came down. And now I know what is my range. My range is this bit. This is my range. I know it. And I've already seen this price action as well. So what happens? Price breaks out of this. Price breaks out of this, goes up, pulls back to it. And guess what it's done? This is a very classic way of trading, you know, price action. You have a 2 candle, you can even call it a 3 candle pullback. And there's a confirmation candle as well. So this is a bullish, although it looks red, but it's a bullish confirmation candle, because it's a long tail here, and look where it's bounced. It's bounced around here, and then it's here. So I went long above over here, then I went long above that high. Then as this candle closed, I went long again, and I was targeting this level, but it went straight through it, went up, and around here we got out. But meanwhile, when this happens, so look at it. So that's the first pullback. And then you have the second pullback, and in there you have the hunt signal as well. You might have received a hunt signal here as well, but we have the settings different. So if I were to say, okay, don't filter the purple for me, then I have a signal here as well. You see this? So in a way, I'm introducing you to the hunt 2.0 signals as well. So, but instead of calling this the introduction to the hunt signal, I wanted to talk about that we need to focus on what price does within the patterns that the indicators are creating. Inside those, within those patterns, we need to also look and learn about the price action patterns. I've done it for so long that I've come to a point that I can actually now not have the indicator patterns, but I can still see the indicators. I can still see those patterns. So if you can't see those patterns and you take your indicators off, you haven't trained yourself. You don't know what pattern you're trading. So if these indicators are not there, I can still see the 3, 4, 5, the push, pause, and push again concept is there. So it goes up, comes down, you have a hunt signal. But if you were to, you know, react to the chart only after the signal, it would be too late. You could do that on the hourly or the 15-minute chart, but not on the 1-minute chart, maybe on a 5-minute chart as well. But sometimes if you were to wait for it and you don't understand why not sometimes actually, you must understand why the indicators work, how they work. They work based on this particular pattern. So the attempt that I'm doing in this video is to kind of explain what that pullback pattern is. And based on that pullback pattern, we have done our best to create an indicator that can actually show you a pullback, you know, kind of give you that. So it's based on these rules of like price on the correct side of the gator, AO above the zero line, then this pullback happens and you have a confirmation candle. So the Hunt 2.0 is the pullback method. But if you remember my video that I shared on YouTube, there are two ways of trading pullback. One is to simply look for pullbacks and then go long above the high of the candle. And the other one is to look for pullback and then wait for a confirmation candle. The Hunt method here looks for a confirmation candle. So I wouldn't take this trade. You know, I wouldn't take this signal. Why? Because I'm inside the range. I don't know if this is a trend up. I don't know if this is a wave up, if it's a pullback down. I want the range to be broken. So when the range is broken and then there's a pullback and there's a retest of the range high as well, then that's actually a high probability trade for me. Even though it's within a stock market kind of, but we have confirmation that price went down, went up, came down again, rejected, went up and pulled back. And then after that, it actually broke those range. So yes, why not? We go long here and long here. That's your two nice, lovely trade on the M5. Another trick, if you go to the M1 chart now, and I'm going to display both the charts. If you looked at this signal here, 1220, and come here, this is 1220 as well. So what do you see here? You don't see a setup 1, you see a setup 2. So when you have a 1 or 2 candle pullbacks on the M5, you'll have a setup 2 where you have a clean wave 3 going on. But the gator doesn't fully sleep, it just goes sideways, so you go long here. It pulls back a bit and then goes up. There's another cherry here. What time is it? 12:45. Now look at it. 12:45. Here, it did not give you that box. So you didn't have the luxury of going in here. We had to go up there and the box was big. So it kind of that. But I'm sure you can already see is that if you understood this concept, then you can apply that concept to the M1 chart as well. So here's your range. Price breaks out of it, pulls back, you can go long here, then goes up. Then it pulls back, but it's because it's gone to the other side of the green line. Now I'm not looking to take a trade on this. I'd rather be looking at the M5 chart, but that's a different discussion. So if it goes back out of the gator, then it pulls back, you have another trade here. Then it goes up, pulls back, you have another trade here, right? And you can hold that trade all the way there. So the pattern is very, very simple. All you have to do is to make sure that your chart actually is moving, it's trending, that the gator is open, and then you keep getting those pullbacks and you keep getting 5, 10, 15 pips again and again. And that really is very simple. So I traded either with this template, or in most cases I will be with my simple template like this. The past couple of months I've traded most of the time on the 12-second chart, but now I'm shifting more towards the M1 chart. I want to have a little bit more relaxed because I trained myself on the 12-second chart. Hundreds and thousands of trades I took. I took it on the live account. When I was done with my live, I would go to the demo account and I would continually trade and trade and trade. Why? Because I wanted to perfect that pattern. So the reason I'm showing you this now is that if you look at this template, and although that other template, that pattern that we have, the setup one, is very, very useful, for me now, I already see that pattern. It's inbuilt in me. Now I want to see is what price is doing. So if I look at this pattern now, and I have all that information behind me, I can actually see those levels without the indicators a lot more clear. I can see that how price went up over here and how this market has reacted to these levels. I can see why this market is moving down. I expected it. I can see it. I know that the market is not moving in one direction today. I know what's happened yesterday, right? I know that yesterday the price went really strong up, and usually after that you would see that price would consolidate and go sideways, which that would mean, and that on an hourly chart you'll have a red candle, a green candle, a red and a green candle, which would turn into market going up and down like this on the M5 chart. And how do I predict it? I just look at these levels. So look at this level. These levels are here, price comes to it, the buyers run out of steam, sellers take over, price starts coming down. Where is it going? It's this level. See these levels happening. And before I forget, I said that I will show you, I will check what happened over here. So if you go to the hourly chart, what happened over here? Well, nothing really. Probably these levels, but these are too far. So what we see is that price actually just tried to break below this level, which is the pre-market level, the overnight session. It tried to go below it, but sellers didn't have much power. Buyers took charge, they went up, reacted to this level again, comes down, reacted to that same level again. I like to see the same level of the same day or the day before, not too much behind, but sometimes the same week, you know, like a high like this or a high like that would play its part. As you can see over here, it played its part. These highs, this high, as you can see, this high played its part here, but then eventually price broke out of it. So we have a kind of a long bias going on, but it's a sideways market, and that's what it is. So another one thing that I will talk about now is that between these two strong candles, if I put a line here and drop to the M1, you would see some pullback, which didn't happen on this occasion, because as you can see, there is not much wick. You can't see the wicks between the two. They're very, very full candles. Between these two candles, you would have pullback. So when the market is going really strongly down and it went kind of one or two candle up, this would be a very nice, lovely short down there. And so that's what it is. And between these candles, like on the M1, if it was a high volatility day, then I would go to the 12-second chart. The reason with the 12-second chart is that there's only moments, there are only lapses, a few moments in the market where the 12-second chart becomes handy. And that is when the M1 chart is printing green candles like this, right? And within these green candles and the wicks, you will have the pullback on the 12-second chart. When I go to the 12-second chart, I completely go into like a zone. I don't know what I'm doing. I'm just doing and doing and doing, and then I'm realizing, oh, it's kind of that. So it's a great feeling, but I don't want that all the time. I want to be more aware. So I'll be trading the M5 and the M1 using this pattern, but it's the same thing as trading the setup one, just with squeezed information. I'm getting there. So if you want to get to this, I think you can start straight away by following the, I know the indicators are not there yet, but you don't really need the indicator unless you understand the concept. You know, like for example, a person relying only on indicators would be interested in taking this, this, and all of this. But what they don't understand is that over here, there's a very strong extension of the market. You know, it's price ran away, it's pulled away from the moving averages, and then 1, 2, 3, 4, 5, 6 candles pull back later. It didn't really shoot off, you see. So even if you took it, this would be the only trade for you. After that, you won't touch it. You'd actually then wait for price to break this level, and then as it broke that level and then it pulled back, you can see, then you go long here, and you have a 2 candle waltz pattern. You know, waltz is a few trend candles followed by pause candles, and then you have a long over here, and you take those few pips over there. So if the market kind of pulls away too much from the dash line, and then if it pulls back and even goes between the 10 and 20, then I'm not interested. I would rather have small pullbacks like this and this. So this is a good pullback, this is a good pullback, this is a good pause. All of these could have been traded, and this is also a good signal. From here you go long and you target those levels. So your little small targets, but they are very, very high probability. You can have like a 70-80% win rate on this. I hope this video was useful. Please let me know what you think. See you later.